Welcome to Darren Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darren Batchelder.
Hello, everyone. Today we have a very special guest. We have Alex and Sarah May. Alex, Sarah, appreciate you guys coming on the show.
Hey, thanks for having us.
Excited to be here.
Absolutely. So just a little bit on how I know these two. First of all, this is the first time that I'm having two people on at the same time. So if we have any technical difficulties, I apologize ahead of time, but I think we're going to be okay. But how I know these guys, they're part of the same multifamily mentorship group that I'm a part of, based here in Dallas, the Brad Sumrock group, and met them several years ago. They've been doing great things, and one of the things that I'm excited to talk to them about is they're actually in a different market. So they live in Colorado and they do deals in Colorado, and actually I just invested in a deal with them at the end of the year, and they're doing fantastic. So I'm looking forward to this conversation. Alex, Sarah, typically first question, how many properties and how many units are you guys currently invested in?
Yeah, thanks, Darren. So we've invested kind of all three ways. Individually is how we started out. So we have some of those properties. We're in about 10 passive deals, and then we're working on our fifth syndication where we're the lead sponsors and asset managers. Total number of units for those syndications is around 470 units. So we've been in the business and excited to keep working and moving forward.
Fantastic. So let's just jump right into the market. So talk a little bit about Colorado. Like what, one, are you guys from Colorado? How'd you end up in Colorado? Two, what's it like from an investing standpoint in Colorado?
Yeah, well, Colorado is one of the strongest markets in the U.S. Last year, rent growth was over 10% in all the major metro areas. Lots of people are migrating into Colorado because we have, good weather, lots of outdoor activities, lots of employment growth. So that population growth has been fueling a big housing surge and housing demand here in Colorado. I think, the average single family home price in Denver now is over $650,000. So to be able to afford, to provide more affordable apartments to people is definitely something that the market has demand for in Colorado. And we've been investing since 2007, actually, and saw a little bit of the crash just with a couple of rental properties that we had, and we're able to ride that out just because of the strong cash flow, and rents never really went down. And, the last 10 years have just been up, and lots of great demand drivers here in the state.
That's fantastic. That's consistent with what we're seeing in Texas. Now, the migration, we're seeing a lot of people from California moving into Texas. Where's the migration coming from? Is it, I hear New York, Chicago, and California, the three areas where people kind of are moving out of. Are you seeing those three kind of, coming into Colorado, into the Denver area?
Yeah, those are all some of the big players coming here to Colorado. We know a lot of Californians. I'm actually from Iowa, and I think every day I meet someone new from Iowa who moves to Colorado. It's just kind of a Midwest draw. People like coming to Colorado because it's, like Sarah was saying, a lot of fun activities, strong job growth. I moved here originally for my career. I was in engineering, doing aerospace engineering for Lockheed Martin, and moved out here for that about 20 years ago almost. So between those areas, and we also see a lot of people even from Texas coming up here. Texas is getting a lot of growth from all these other markets, but some people I think want to escape the heat probably, and they come up to Colorado. And depending what your preferences are, there's definitely pros and cons of both places. And
I live in the Dallas area, and I was just talking to my wife about trying to rent someplace up in Colorado for about a month this summer. We'll see if we make that happen. But beautiful country in Colorado, a very attractive place. But that's one of the things I wanted to get your take on was, it's expensive, right? I mean, in the Dallas market, when I first started in the investing side about 4 years ago, I ran into people that were like, oh, Darren, man, I was buying at 30, 40 a door. And at that time, I'm like, well, and they're like, I'm out, right? And then I'm like, I'm in. And I bought at like 80 a door. Well, now it's like 140, 150 a door. But Denver is, significantly higher than that. So, one, what does Denver apartments look like in terms of per unit and cash flow and total return look like? And then, what's your forecast? Do you think it's going to continue?
Sure.
Yeah, I think, I think that kind of doubling you mentioned is something we've seen similarly here. The fact rents have gone up everywhere, but here it's gone up a lot too. The price per unit here is definitely higher than in the Dallas area. I think when we got started, things were often we'd, be going after deals in the 100 to 150K per door range. Our first syndication was about 150 a door, and all of our investor friends from Texas it was hard for them to stomach, but we showed them the financial projections and the rationale for why those prices are what they are. And sure enough, we're actually selling that first deal we syndicated for, upper 200s now. So it's essentially been a double in the valuation of properties around here over the last, 4 or 5 years. But the fundamental, the math kind of all makes sense. Some of the expenses here in Colorado are lower, especially insurance and taxes, and rents. The incomes here and the rents here are a lot higher, and so it kind of turns out cap rates are pretty comparable to the Dallas area and other strong markets. So yeah, it pretty much all makes sense. We try and keep an eye on if we're going after assets, making sure that we understand what the replacement cost is for construction, and to build new property around here, it's typically $350 per unit.
$450.
Yeah, maybe in the last year it's gone up now closer to $450. So if you're buying stuff around the 200 to 300, like that makes a lot of sense, especially given the demand.
Yeah,
absolutely. So go ahead.
So
Sam.
I was just going to add, what makes a good deal to us when we do our financial analysis on a property is we like to be able to provide, over a 5-year hold period, somewhere around 7 to 8% annual distributions, an IRR for the hold period around 14 to 16%, total return to our investors around 70 to 100%. So that would be like up to a doubling of the money. That's kind of what we like to see. We like to use the conservative underwriting to make sure we can get to that number safely and conservatively. I know you asked our projections, and I think for the Colorado, primary markets, there's going to be continued rent growth, just with all the demand for housing. There's also a lot of development going on, but I've been to several market analysis, economic projection seminars, and everyone's still saying, they're building a lot, but still not enough to keep up with the demand. So, should be good indicators of a strong market for years to come.
Absolutely. And the other thing that Alex said was that knowing the local market, I think, is so key. So, I'm invested in a lot of properties in Texas, and I wanted to get some exposure to Colorado. But for me, being in Texas, buying at 200 or 300 a unit is difficult for me to get comfortable with. But when you live in that market every day and you see where things are trading, and you see, the income, you see the expenses, you understand it, and you see the migration patterns coming in, then it gives you the confidence to go after that deal. So for me, as an investor, I wanted to partner with people that knew the local market very well, such as yourselves.
Yeah, thanks. It's definitely important to kind of know the market and what's going on. And, we follow a lot of newsletters for local news. And like just last month, we got a list of all the recent transactions across Colorado with more than 10 units. And, Alex and I both looked at each other. We said, can you believe this? Anything built after 1990 was selling over 400,000 a door in
Wow.
Colorado. So it's just, it's a hot market. It's lots of demand here. And yeah, when you're comfortable with it and you look at the numbers, project a healthy financial return, like it's still exciting and a great market to look into.
Absolutely. So, but it also comes with experience. So now you're on your fifth syndication. As you get more experience, the confidence grows as well. So talk a little bit about maybe going back to your first syndication and, one, did you have to partner with other people and did they have experience? And then, what were some of the kind of mindset shifts that you had to do in your mind to get comfortable to actually pull the trigger?
Yeah, our first syndication deal, we did partner with some folks out of Dallas actually who were looking to get into other markets, and we were local here. It's easy for us to go tour deals. We know the good areas and any areas we should avoid, and have built some great relationships with brokers and whatnot. So yeah, going at first, we went and we were underwriting lots of deals and touring, and we pulled some partners together with us to go after our first one that we got. And it was about 4.5 years ago. It was definitely a mind shift because it was, going from stuff we'd done previously, doing a lot of 4 to 8, maybe 10 unit type properties around here. And we jumped up to 100 units, and it was, a nice 100 unit property. And that purchase price, it was $15 million at the time, which was a lot. So it was a big mindset shift but fortunately, it was great having the good ecosystem that we had in the group that you're a part of, Darren, and some great partners that we knew we could do this as a team. And yeah, that's exactly what happened is we pulled together a great team and were able to qualify for, getting lending and build up the syndication team for raising the funds and purchase the property, and been doing a great job managing it. And yeah, Sarah, she's been, it was the first syndication we've done. So she, spent a lot of focused effort, just making sure we really understand the business and we're giving it our full attention. And, so that deal's gone really well and we're selling it now. And after that first one, we kind of just started looking for more. And the next couple we found were smaller ones compared to that first one that, as far as the capital raise, and we just felt confident, that we could do it and have done kind of the rest on our own. And now we're kind of at a point where we're realizing we need to start partnering potentially with other folks to go after even, the prices are getting so much higher, and just building teams up again. So it's kind of been our new focus now, is start looking for other people who want to be partnering to go after a bigger assets that we can do as a team again. We're still, keeping our eye open for anything we can tackle ourselves, but definitely open to strategic partnerships and growing.
Yeah, and
Fantastic.
one thing
Sorry.
I was just going to add to, we're both come from engineering backgrounds where everything is mitigating risk, and you typically tend to be risk adverse. And so for us, taking the step from moving from using our own money to invest in real estate to now, leveraging other people who wanted to invest with us and using their money to invest in real estate, that was a big mental hurdle for me. Because you want to minimize risk and you don't want to put other people's, funds at risk. So the two things that really helped me with the mindset was you're not selling people on an investment opportunity, you're providing them with the opportunity to invest in this great project. It's not a sales pitch, it's an opportunity presentation, if you will.
Right.
So that was one thing. It's not about trying to sell somebody on the idea. And then the other thing was, if you are nervous about taking somebody's hard-earned money and putting it into a project, that means you have the ethics and integrity to be in this business, and you need more people like that who are offering this type of investment to people. So it's like, if you're nervous, that's actually a good thing, because you have the integrity.
As long as you're still able to take action,
Exactly.
right? I mean, because there's a lot of people that are nervous about that hold them back from ever doing it, right? So you guys were, nervous about it, but you were able to push through and still take action. And I think that is so important, for listeners to understand that, look, most people, when they first do their first syndication, they're nervous, they're scared. But, the ones that are successful, look, you're on your fifth syndication now. You're 470 units as a general partner. And prior, you were doing 4 to 10 units, and you could have just stayed there, right? And you ended up finding a way to take that action. And that's the difference that I see with people that, get into the 500, 1,000, 3,000 units versus the ones that are still doing the fourplexes, is they can't get past that.
Yeah. Yeah. I think, Sarah mentioned we come from engineering backgrounds, and we both were aerospace engineering, and we worked for space projects. And our mentality there is, in the space world, is you have to be perfect. Like, nothing can be wrong, because when you launch spacecraft, like, if anything is wrong with them, you can't just go repair it, right? So there's a lot of risk analysis always being done, and really trying to make sure that there aren't problems. So we we don't have quite that severe of a risk tolerance to multifamily, but at the same time, we bring that mentality of a lot of the what if analysis, and it's the beauty of it is when you can do what if analysis and account for all of the worst case scenarios, and show that, hey, even if this goes wrong or this goes wrong, we're still going to be okay. That brings a lot of confidence. So there's it kind of helps sometimes to be able to do all that very analytical work and worry about things, because then you can prove to yourself, hey, look, this is not really something you have to, maybe the returns wouldn't be what you want them to be ideally, but at least you're going to be fine, and you'll do good for your investors. Yeah.
Mm-hmm.
Yeah. Hey, that makes me comfortable being an investor in your deal. That you guys have that background, and look, nobody can be perfect, right? You can't be perfect as an individual, and you can't be perfect in every investment, but that you guys are taking the due diligence and looking at everything from different angles is comforting from an investor standpoint. Sarah, you said something that I think is really important, and when you talked about opportunity, I think that a lot of people get hung up on, when you go to raise money for other people's money, that I need the money to do my deal, right? Versus what you said, you're just presenting an opportunity. And if they pass, then you go on to the next person,
Exactly.
and once you learn that, and you really accept it and believe it, then it's completely different talking to different people, because it's not a pitch. You're trying to get something from somebody. You're trying to help them, you're trying to help grow their wealth. And, with that, you're pulling all these people together that have the same goal, and you're just being the team lead.
Yeah, for sure. That was definitely a mind shift, because, again, being engineers, we're not salespeople by nature.
Right.
And so hearing that I didn't need to be a salesperson, it was just, giving people the information they need to make an informed decision. That really helped kind of shift my, my perception of the business when I was just starting out.
So talk about, the listeners on this show, it mainly passive investors and also syndicators that are looking to scale. So, from the passive investor standpoint, I'm not sure that everybody knows, what the risk level is for a syndicator. So talk a little bit about, all right, you guys going, because as a passive investor, they're getting hit by, a number of different syndicators that, hey, invest in my deal. So they just think that, hey, they want my money, right? But you're not going to enter into a contract unless you're pretty darn certain you're going to close, right? So talk about the risk for the syndicator from the time they sign the contract to the time you actually close the deal.
Do you want to take this one?
Yeah. Well, during that closing period, yeah, there's risk just in the sense of, there's a lot of time invested, but really the financial risks start amounting when you're building up a team, you're starting lenders up to start the loan process. You work with attorneys, and that's not inexpensive. So there are a lot of upfront costs that go into these deals.
Who pays those upfront costs?
Yeah, so the syndicators, the leads will front all that money to help kick off these projects with the loans, the attorneys. You do earnest money to let the buyer or the sellers know that you have the funds to be able to support this, show you're committed. And sometimes you're doing earnest money, like essentially hard, meaning non-refundable day one. Like you have a lot of confidence and you want to make sure you're comfortable with that when you're doing deals. And so yeah, you're putting up quite a bit of funds up front. And once you close the deal, it's just like all the other closing costs. That it's just one of many costs that go in to the overall project that everyone's kind of sharing once you get the deal. But yeah, there's a lot of upfront risk there for the
I think
sponsors.
that's important for people to understand, is that, like, look, you're putting up typically six figures, hard money day one, and then you're paying for the attorneys, you're paying for the inspection, you're paying for the the loan deposit to get that started, and then yes, when it closes, those are on the closing schedule and you're refunded. But if you're not able to raise the funds to close the deal, right? That money you lose it as the syndicator. So the syndicator isn't just trying to put any deal under contract. They have to be confident that they're able to raise the money and then it's a solid deal, or else they're out, all that upfront money. I'm not sure that every passive investor understands that.
Yeah, that's very true. There's a lot of risk up front, and I think another risk is not even like the financial piece of those expenses, is just kind of reputation. This business,
reputational risk,
this business
right,
is so relationship dependent, and if you don't close a deal, that can run pretty. Because once you have a deal under contract, the whole world knows. At least the world being the local community and everybody, all the brokers and stuff knows this is under contract now, and it quickly gets out, who's working that deal, and if it falls through, that could definitely be a challenge to recover from. I'm sure it can happen, but we've made it a point to make sure we're really careful on what deals we're going after strongly. And when you're doing that like best and final offer and you're ready to go and like put hard money down, like you want to be committed and know that it's the right deal.
Yeah, absolutely. So now you guys are in 5 syndications. Can you share with listeners any lessons learned?
Yeah, I guess lessons learned on the syndication side is just know your timeline really well. There's a lot of moving pieces when you're working with the title company and the attorneys and doing your due diligence and your fundraising simultaneously. That's at least the way we've done our deals. We find a property that we like, and then we raise the money after we get it under contract. Some syndicators raise a fund. They raise the money up front before they go and find the property to buy. Pros and cons to each method, and just understanding the timelines really, really well and what needs to happen at each of the different stages is key. I think the one that throws off most syndicators is setting up bank accounts, because you have to have a bank account, right, for your investors to send their funds to, and then once you own the property, for your property manager to operate the property with. And I think that's something that the first time we did things, thankfully we had experienced partners, and we were able to get that set up. But you first have to have your LLC set up. You have to get your tax ID number, and then you have to go to the bank and set up your account. So, that's just like one little thing, but just knowing the timeline while you're under contract is important.
Yeah.
Absolutely.
Yeah, I like that a lot. Just kind of drafting out all the steps that have to happen to get to closing, and how are you going to do your fundraising, and if you're working with an attorney for that, putting together all the subscription documents and the time it takes them to do that, and how are people going to subscribe, and how are you going to do your marketing for letting investors know and about the deal, and doing your, we like to do a webinar to kind of walk through the business plan. So what's the time frame for, building all that up, and then opening up for subscriptions to start bringing funds in. And yeah, I think that's a good lesson learned for sure, just having a really well-defined schedule when you're going into something, just to be able to keep track.
And for the listeners' benefit, you mentioned webinars. I would say look, if you're looking to invest passively, decide what market you want to invest in, and then meet a number of syndicators in that market, get to know them, and get on their investor database. And then when they have a deal, just like Alex just said, they're going to send it out to the investors that are on the list. Mm-hmm. Sign up for that webinar, even if you're not ready to invest. You watch the presentation of their business plan. What are they planning to do with the property? And that's how you learn, is to be watching those presentations. So 5 syndication deals. I have to imagine that each property was a little different, and that, maybe one thing was more important, in terms of rehab at one property versus another, maybe, putting in dog park or putting in, so talk a little bit about how you guys look at these different properties differently and determine, what you think the property needs to kind of go to the next level.
Sure. Yeah. So, I think there's interior and exterior renovations is usually the cosmetic improvements that you look at. The first syndication we bought, the exterior looked really nice and was well taken care of. So we didn't have to do much there, but we, renovated every single unit when someone would move out, and, did a really nice modern renovation. And so that way, when people came looking for a place to live and they saw the property, everything was cohesive. The outside of the property looked nice, the interiors looked nice. And so that was our value add plan. Our second property we did, it needed both exterior and interior. And so that was, definitely kind of your great before and after story, because it just was, didn't look the most attractive. And we were able to completely repaint, redo the parking lot, rebrand for the exterior. And then on the interior, update all the common spaces like the office and fitness center, hallways and things like that. So when people came in, it just had a totally different look and feel than it had before. And when somebody's just coming for a half-hour tour, you want their experience to be enjoyable, and that they can imagine living there, and bringing friends over or whatever, and being proud to say that that they live there and that's their home. So I think really important on the kind of the exterior and common features as well as the interior, and just to make sure that those two, kind of are consistent. Because even if you renovate units and they look amazing, but the parking lot's falling apart and the building hasn't had any exterior renovations done in 50 years, like, you're not going to get the rents that you need. So just kind of making sure that
you may not get them to stop by, right?
Right.
That's the one thing that I heard from a lot of different syndicators is do the exterior as fast as you can, because then you start to get the drive-by traffic. That, oh wow, they're putting money into this. Let me go take a look at it. Versus, like you said, they drive by and the parking lot's full of potholes. Then they're like, you know what, I don't want to live here. I'm not even, it doesn't matter what the inside looks like.
Exactly.
So talk about, networking and going to conferences and masterminds, and, what do you guys do, and why do you do it?
Yeah, so like you mentioned, we joined Brad Sumrock's mentorship program. It was about 5 years ago. And that was a mind shift thing. It got us into the syndication business. It was something we are trying to kind of figure out on how to do ourselves for, I don't know, 6 to 12 months. We knew we wanted to do kind of bigger stuff, and we heard about syndication, but it was really hard to find out all the specifics we needed. We always would run into a roadblock if we started going down the path of, pursuing it, and it just, everything felt new and kind of complicated, like, dealing with syndication attorneys. It's like, oh gosh, like, what does that mean? And when we got into that ecosystem that Brad created for us, for his whole group, it was amazing to see all the other people who were having such success. I connected with, someone who was an engineer, same company, who had done this, and it's build immediate trust and can be like, oh wow, like, this is for real. People are doing this and they're buying 100-unit buildings, and it's not that big a deal. And it's not when you have that mentorship and people who kind of show you the ropes and make sure you're not missing anything, and that because you're, Sarah was saying, we're taking on other investors' money, and that was honestly like one of the hardest things when we first did that. It's easy for us to buy our own deals, and we know the market. We can kind of use the gut feel a lot of times. We'll do analysis, but like, taking on other investors, like, we really want to be rigorous and make sure we know what we're doing. And so getting all the training and learning there, guidance from coaches and just seeing other people doing it. Sarah mentioned we've been in over a dozen passive deals. And so that's been a really good experience to see how other sponsors are running their deals, their business plans, how they communicate with investors. So we've learned a lot through that, both the things we like and don't like, and where we want to, set ourselves apart and do good as a syndicator. The mentorship groups and just going out and networking with people, and that's where we've built up a lot of our core investor folks, like people who are in the business. They know they want to be doing multifamily, so it's easier to either build partnerships or find investors who want to be joining us on opportunities. And now we're kind of at a point where we're starting to reach out of that community more, and like Sarah was saying, like, these are opportunities. Like, we need to be telling more people. It's not just the people who are at the real estate meetups, because they already know about this stuff. We can at least teach them about our deals and what we're doing, but like, there are so many people out there who don't know anything about real estate investing, or they've heard of it and they know it's probably a good thing, but how the heck would they be a part of it? Like, they have to find a realtor and go find a duplex or find a condo they're going to rent. Like, it's like, no, like, there's a much easier, lower risk ways of getting involved, and like, that's what we're getting excited to start sharing this more with other people. And
that's fantastic.
Yeah,
I wholeheartedly agree with that. I mean, it's just, so there's so many people out there that still don't know. I didn't know, until 4 years ago. I didn't know you could do it, So a few things that you said. One was for real. You wanted to, like, when you saw all the other people that were doing all these different deals, you're like, wow, this is for real. And I think that that's a powerful thing about, being part of a group of like-minded people is just surrounding yourself with people that, one success story after another, and that gives you more confidence to press forward. Some people, they question whether they should go to a conference or they should, join something and like, look, I get it. It's an investment in dollars and in your time, but you have to ask yourself, will you do it without it? When you surround yourself with other people, it helps give you the confidence, and, they root you on. I've met so many people that have helped me along the way, and I know you guys are in that same boat, and then we all kind of grow together.
Yeah, definitely. No, it's really fun to be a part of that community and, growing together. I like that a lot.
The other thing you said was, you thought being a passive first was good for you guys. And I would agree with that too. You said you look at what you like and what you don't like. And I think that's important, is like each syndicator has their own style and their own, communication style. And there's certain people that, you know, you'll continue to invest with, and there's other people that you may not. And even the ones that you may not, the returns may be great, right? But maybe you just didn't click with that syndicator as much, you know, and so you're probably going to allocate funds, you know, to a different one that you click with more, that has more of your style. So I think it's important if you're looking to become active in the space, you want to become a syndicator, you know, go and be a passive first to learn from the other side.
Yeah, and I'd say we've definitely learned a lot, you know, even underwriting tips from being a passive investor. Like, you know, a couple things we look at now in any deal, whether we're sponsoring or investing in someone else's, is, you know, are they treating the property taxes, you know, appropriately? Are they accounting for, you know, the future increase in property taxes at the next county assessment date? And then another one is just, are they, you know, is whoever's leading the deal accounting for adequate working capital, we call it, which is just extra money that's not allocated to anything up front, but it's just there kind of as a rainy day fund if something goes wrong, like, you know, an unexpected boiler went out, or roof repairs, things like that. Because that's really important for a deal, because to expect everything to go exactly as planned for a 5-year hold period, you know, that's just not how real life works. So it's nice to just have that extra security of extra money on hand for a deal. And, you know, realistic rent growth, realistic cap rate projections for when you sell down the road. Those can make a big difference in whether the deal's underwritten conservatively or if it might be too aggressive.
Absolutely. And you may not know all of those things the first time you invest, right? I mean, you try to learn as much as you can, but over time you see these learning lessons. You know, my first syndication deal, you know, I underwrote, we bought in Tarrant County in the Texas market, about 20 minutes south of Fort Worth. And we underwrote at 80% of the purchase price for property taxes. Well, the county went and valued the property higher than our purchase price. So that's a big number, you know, differential in your business plan. Now, we were exceeding our rent increases, you know, on the turns. So we were able to absorb it, but we had to, you know, hire a company to go and fight that. And we ended up bringing it down. But to your point, if somebody, you know, had underwrote that at the existing property tax value, you know, that would be a huge differential in the business plan, you know? So, you know, understanding which county really pushes the envelope on property tax valuations is very important. The other thing that you didn't mention, which is kind of near and dear to me, because I have another business that trades loan portfolios, is the loan that you're going to put on the property. And a lot of passives don't really focus on that, but I think that for me personally, because of my background, the term of the loan I think is important, because during the 2008 2010 recession, where I saw loans go bad and banks take them back, was when a loan came due in a recession. You know, so cash flow is down, maybe cap rates are up, valuations are down, and all of a sudden the loan comes due. You're forced to either refinance or sell the property, and you know, I just don't want to ever be in that position. You know, so knowing, you know, I've invested in a couple deals with short loans, like, you know, bridge loans, 2 and 3 year bridge loans with extensions, but I knew that that's a risk, you know, and I think that it's important for investors to know that what is the term of the loan. It's not like a 30-year fixed rate loan. The loan is going to come due, and most of these deals, you know, look, even if they have hiccups, if you even said it before, like you went through the recession with your existing portfolio, your small deals, and you were able to ride it out. You know, you wouldn't want to be forced to sell in that downturn. So that's another thing that is important to me. What kind of sacrifices have you guys made, to get into this business?
Well, so after we joined Brad Sumrock's mentoring group, I actually left my job as engineering and I went full
Congratulations.
time. Thank you. And, just went full time and wanting to focus on real estate, have a bit more control over my schedule. But it was hard. I mean, I thought with our existing real estate experience and joining the mentorship group, I thought we'd have a deal within a couple months. And it ended up being close to a year before we closed on that first deal with our partners. And, I think that's the sacrifice is just staying with it. Even if the going gets hard and it sometimes seems like, it's just not going your way. It is a tough business to get into. Most of the brokers know the big buyers in town and they've done business for years together. And when you're the new kid on the block coming to, buy these larger properties, there's a little bit of like, well, prove yourself first and then we'll take you seriously. It's a little bit of that. And then I think just also growing as an investor, coming right off that uber conservative engineering background where you basically want to minimize risk to zero, to realizing that, we don't have to be as conservative in some of our underwriting metrics. Let's be more realistic, not aggressive, but realistic in some things so that we can win deals, and just kind of refining what was realistic and what could still win deals over time. So that's just a matter of experience and gaining the experience. But I mean, we really love the business. Like it's a ton of fun. Like we're in that mentoring group, and just last week we did a mastermind in Lake Tahoe, and half the time you
Nice.
spend in sessions like learning the best about the business and shifting your mindset and talking about goals. And then the other half, I mean, we were out skiing and snowmobiling and just having a great time. So it's a great business. I feel like people are very good at kind of integrating the work with the
With
with
fun,
fun.
right?
Yeah, it's
Yeah,
been great. I mean, we can't think of anything else we'd rather be doing. It's been a great journey.
that's fantastic. Hey, there's a few things that you said there that I think is really important. One is you thought it was going to be easy, but it actually was hard. Like, that's one thing that I'll say when people reach out to me on Instagram or whatever. I'm like, look, I would highly recommend you to join a mentorship group. Surround yourself with like-minded people, but just know that striking the check is not going to get you a deal, right? It gets you in the door, it gets you access to all the people, all the resources you need, but you still have to fight, kick, and scratch to get your first deal.
Yeah.
It doesn't just get handed to you. Another thing you said was realistic. I think that it's a natural process for new investors in the market when they start underwriting deals, and underwriting is just, taking a bunch of data and putting it in an Excel spreadsheet to see if the returns are there. In the beginning, it's really easy. I know I fell into it, and I've talked to a lot of people when they first started underwriting. There's a lot of like decision points. And if you are conservative on every one of those decision points, guess what? The deal doesn't look good, right? And you don't pursue it, and somebody else buys it, and then you're like, and then you see that they turned it around and made a bunch of money, and you're like, how are they doing it? So surrounding yourself and learning, that's why I said those webinars before. Watching the webinars and saying, how are they winning the deal? Even if you're an active person and investor and you lose on a syndicated deal and the party that won, get on that webinar, see how they underwrote the deal, and that might help you on the next one.
Yeah, that's good.
Yeah, lots to learn from everybody and share ideas. And I mean, even just one good idea can make the difference between, losing out or being able to make a deal work. Like some of the other income sources can be huge. Like we didn't really factor that in when we first started underwriting deals, but things like billing back for, water and sewer charges, that's an easy one. It's pretty mainstream anymore. But then more creative things like, carports or package lockers. I mean, there's one property we're talking about adding a electric car charging station, and you can make a little bit of residual income from that. So there's lots of ideas, and just the more people you talk to, you'll just get more and more of those great ideas.
Absolutely. That's part of the networking, right? I mean, so the networking, part of it is, trying to grow your investor database. Part of it is networking with other syndicators, and why would you do that? They're your competition. Well, everybody shares ideas and can learn from each other. Like, hey, I did this on my property, and wow, that's a great idea. I haven't implemented that, but another syndicator may have 5 or 10 other properties that they implement that one idea on. May be substantial revenue. Another thing is having that Rolodex. You come up with a problem, right, at one of your properties. I don't know, maybe you have a fire at one of your properties, never had that before, but and this other syndicator had that problem, and you just call them up and they talk you through, hey, this is what I did, and like, whoa, okay, now I'm at peace. Like, I'm not having to try to figure this out on my own. So the community is very giving in terms of sharing of information.
Yeah, no, that's great. And I think we've really enjoyed getting to know the other syndicators, just getting to grow together. We're always looking to, look for other new opportunities too. So we're in Colorado. That's our main focus. So we do a lot of our syndication here, and we, that's our saying, we purchase deals for ourselves here. So we're kind of like very focused in the Colorado market, but we know other people who are doing great things in other markets that we actually want to be joining their deals and diversify our portfolio a little. So whether it's Dallas or Phoenix or Florida, like all these other markets that are doing really well, we'd like to be, keep growing our portfolio in those areas too. So we join passive deals, and then we're kind of starting to get to the point where, back when we got started, we were trying to figure out, hey, we're local here, how do we get our first deal? And we had folks in Dallas who wanted to join us. So now we're kind of like, well, hey, we're doing passive investing other places, but we'd be interested in, helping other people who are trying to get started in other markets that we're not necessarily going to be out meeting all the brokers and touring all the deals. But now we have some of the experience to be able to bring to the team to help go after deals that they're interested in.
Isn't that crazy? It's like, did you think 4 or 5 years ago that you'd be, not only, doing all these large deals, but now, hey, I would be open to partnering with somebody that has less experience, and now you're the experienced folks. It's like, it's funny. It can go in a snap of your finger that all of a sudden, like, holy cow, this has grown. And my confidence level is so different, and my knowledge level is so different than it was before, that you're able to say something like that. That's awesome. And that's the way it happens. It's like people taught you, and now you're turning around and helping other people learn, so that's fantastic. I was going to ask you, how do you continue to get uncomfortable, but maybe that's one way.
I think there's plenty of ways in this business.
You think that, once you get your first deal, you're going to know everything, but it's like, holy cow, it just keeps on layering on. So talk a little bit about getting uncomfortable.
Sure. I mean, I think the way everybody thinks is just going bigger. So instead of doing 100 unit, what about doing a 200 unit property, for instance? So the size of the deal, both in number of units and also total dollars invested. A lot of people in our group, which kind of started out as more, workforce housing, older properties, which everyone was going after. Now people are buying brand new 2020s built properties. And we're really excited to see people kind of figure that out. And know how to run that business model. So you can buy nicer properties, you can buy bigger properties, you can raise more capital. I think one thing Alex and I are kind of interested in too is learning a little bit about development. I don't think we'd be at a point where we'd do that on our own right now, but something that we are keeping our eyes on, just learning how the construction process works and how that goes. I mean, other ways to grow, there's so many different types of renovation projects. We've done a lot of the cosmetic renovation projects and have experience with that. But there's a lot more intensive work that can be done, like, you know, adding sprinkler systems or changing out plumbing lines. Like these older properties sometimes need a full plumbing change out. So we haven't done that yet, but there's always ways that you're learning and growing. Anything else, Alex?
Um, yeah, yeah, I think one of our key focuses is going after potentially, newer or bigger properties, whether it's unit count or just purchase price, and getting uncomfortable. And I think we've seen that in a lot of our peers too. They they get uncomfortable by going after bigger deals, and just means because then it's like, okay, how are you going to raise these funds? And that's whether it's partner with other folks or how we get out there more and meet more people to share these opportunities with them. And that's an area we're looking just to keep growing and getting uncomfortable with.
Yeah, I mean, it's crazy. So the thing that there's listeners that maybe they're just looking to get in the first passive, or maybe there's listeners that are looking to do their first syndicated deal. But one side benefit that I don't think that people really think about when they're first trying to get their first deal is, there is really a ripple effect. Like, so if you figure it out, right, and then you bring other people on and you do deals and you help grow their wealth, then all of a sudden other people start coming to you and say, how did you do it? Right? And then those people learn from you, and then they go out and do it. And then people learn from them and they go out and do it. So there's people listening. I know for me, 4 years ago, I was just thinking of myself. I was just thinking, how do I figure out how to go bigger? Right? And I wasn't really thinking that, okay, once I figure it out, other people are going to be asking me. Right? But that's what happens is once you figure it out, other people are asking you, how did you do it? And that's a beautiful part of life, is to help other people. And so that's something that people don't even really think about a lot of times, I think. Hey, so real quick, total flip the subject. How did you guys grow up? I mean, did you grow up with this wealth mentality, entrepreneurial spirit mentality? Rich, poor, where did you grow up?
Happily middle class for me. My mom was a math teacher. My dad was mechanical, did mechanical work for factories, and they worked hard. They taught me to work hard, but no investing or real estate in the family. For me, it was all just finding out about real estate in college. I think I actually went to a Rich Dad seminar before I read the book, but going to that got me to read the Little Purple Book and learn about assets and liabilities. And then
that book has been mentioned a lot of times, I gotta tell you.
And then the cash flow quadrant, I think, actually made a bigger impact on me, understanding the difference between, an employee and a business owner, and how there's actually tax differences if you're an employee or a business owner. So that was kind of how I got started on it originally.
So were you the impetus, like between you and Alex, or was Alex the one bringing you into the investing world?
It was pretty mutual. So yeah. I grew up with similar background, middle class.
Iowa.
Yeah, in Iowa. Both my parents were business owners. My mom, chiropractor, my dad, an electrician, and my dad actually had several single-family rentals. And I used to, bike around town in the summers and mow grass at those, and I was making a little money. And he also, I think, was instilling some values in me and showing me how he wasn't like cash flowing from them, but I remember him teaching me like he never had to even pay anything down. He'd get full financing and they'd pay for themselves. And so at one point they'd all be paid off. And I was like, wow, that seems like a really good idea. And so there's always a nugget in the back of my head. I thought back there. And then, through college, I really was interested in investing and went into like stock investing clubs and started my career and like did all my stock analysis of like how I'm going to grow my 401k to retire someday. And then that same purple book hit me. I got my hands on that. Read that and just learned about, wow, real estate is like, I remember my dad kind of had, these rental properties. So that really got me going and decided like, I bought my first house as quickly as I could when I moved out here and had roommates. So that was, I guess the old school house hack, having roommates, and then went and bought a rental property. And then, Sarah and I, we got married in a couple of years after that, but we knew each other, and right when we met each other, we both worked at the same company, and that was something we had in common interest, was real estate and investing and lots of other fun stuff too. But yeah, we went off and tried to do fun things. I remember like putting bandit signs out like on a date one time, saying, we buy homes and in the middle of some busy intersection, and like, trying to.
I was like, I am never doing that ever again.
That's great. Yeah, that's great. So what's the next big stretch goal for the two of you then?
Well, we did just do a week of goal setting. So I think this year we want to do 4 more deals as the lead sponsor. We want to keep growing our cash flow from these properties, grow net worth. And another goal for us is to, put ourselves out there more. We really appreciate you having us on this podcast. That goes hand in hand with our goals to, share the magic of real estate with more people and get out of our comfort zone a little bit. We're hiring some virtual assistants later this month to help with some of the, more administrative tasks. And just excited to grow and expand and
Fantastic.
Do more good stuff.
What do you guys like to do outside of work?
Skiing and snowmobiling last week was a lot of fun. We have 2 little kids, 2 boys, 3 and 6.
How old?
Yeah,
3 and 6?
3 and 6, yeah. So they're super fun. We just love spending time with them and swimming or going on bike rides or hiking or going to the playground. Those are all, that's our main focus right now outside of the real estate. It's just.
Well, you got a young family that you're growing, and look, you guys are going to be role models to show them how to get into the investing world as well. Hey, if there's people that are listening to this that want to reach out to you and get to know you better, what's the best way for them to do that?
Yeah, so our company is called Regency Investment Group, and our website's just www.regencyinvestmentgroup.com, and you can go to the Contact Us form, which will send us an email, or you can send us an email directly. I'm Sarah, SARAH, at regencyinvestmentgroup.com, and Alex is the same, ALEX at Regency.
Yeah. Fantastic. Well, I appreciate you guys coming on. Listeners, look, if you're looking to get into the Colorado market, these two are fantastic people, just great people to get to know. And so reach out to them. I hope that you enjoyed that one. And until next week, signing off.
Thanks, Darren.
Thank you for watching Darren Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darrenbatchelder.com/learn.